We have only 2 days to go before D-Day, and by D-Day, I'm of course referring to the RBI meeting on Friday, which is now all of a sudden the most look forward to event. Why did this happen? It's happened because bond yields around the world have been falling, and for a while there has been pressure on the idea that the RBI needs to cut interest rates. The RBI has been unwilling, even though they have moved towards a neutral stance, and the reason for them to do so has been that the inflation data is cooling off, but not as fast as they were hoping for. In the last monetary policy, they have also given out the point that inflation data would tick up a bit into December and then cool off a little bit from there. Now, does this create a window for the RBI to cut rates? The most recent GDP data that came out has actually helped the idea further, because the slowdown in the economy following the slowdown in earnings that were already reported for the October quarter now show that it's about time you take some action to get growth back online. But inflation data is still not cooled off. What it calls for is the RBI to take some preemptive action based on their own inflation expectations over the next couple of months to stimulate growth. The bigger question that I'll probably raise on the economic side is, will one rate cut really do the job? So this has really got to be a series of rate cuts, very similar to what the US has been trying to put in place all over again to get things moving from a slowdown. Now, the US, unlike India, has not been through a similar slowdown, at least not recently. They did see an earnings lag sometime last year. Now the economic data is pretty strong, and there is no clear sign of it weakening yet, even though the new president, Donald Trump, in his second term, does promise to take a lot of steps that can create volatility in economic activity if he goes through with them in the way that he has been talking about. So whether they are, trade wars that erupt or currency wars that erupt out of this, it can lead to a lot of back and forth retaliation agreements on what is the way forward from here. Of course, there's hope that his bite will not be as harsh as his bark, but who the heck knows? He's come in much more stronger than the last time in terms of his positioning as a president in the US House, and therefore his potential to be able to push things through the way he wants to is much higher. So I think till those fears are behind us, we will remain a little worried. But the thing is, after the initial worries, most markets around the world have actually started to take off. So even Europe, which was a little worried about the tariffs that US could actually end up putting on them, you're actually seeing European stock markets run away, whether it's the German market, which is again back to making new all-time highs, or the UK market, which is close to that point, not yet gotten there, but can actually break out of it. So we are seeing a slow and smart recovery now, pacing its way into Europe, much after China's attempt to actually do that, because when China announced the potential for stimulus and took aggressive rate cuts, the Chinese market actually took off one way and went through the roof, gaining around 50% in a short period of time. And ever since then, it has been consolidating. But we didn't see strength in other parts of the world and Asia. Now we see it coming back to Europe. Will we see it coming back to parts of Asia? That still remains a question. But as far as India is concerned, we are seeing some strength come back. So after the bottom that we got close to 23,000, what is the exact level? 263 at the lows. From there, we've seen one leg up, a slight pullback, and then a second leg up. And this entire process has ended up creating a technical pattern that a lot of chartists are familiar with, known as the inverted head and shoulders pattern. And we've broken out of that pattern on the bullish side by closing above 24,320 yesterday. And having done so, it sets us up for a move even higher from here, which should get us close enough to 25,000 if we go by the pattern's implications. So it's a pretty good setup, which means that we still have 400-500 points more ahead of us in this market rally going into the RBI decision on Friday. Now, will the RBI decision itself be the reason for the run-up, or is it going to be a run-up on expectations and a sell-on news event? That is, I think, the big catch over here. It's not very clear exactly which one it will be. But there is growing hope that, like in other parts of the world where rate cuts have worked in stimulating the markets, the Indian market can also run up a little longer than it has if the RBI really starts taking decisions in that direction. Now, even if they do a lot of talk and indicate that they're going to move towards rate cuts in the next meeting, it can also end up being positive. But an actual cut would definitely have a much more meaningful impact on the market on an immediate basis. Having said that, when we look at the entire structure of this fall that we've seen in October with the earnings slowdown, it's indicative of a market that does not want to go back to all-time highs very, very quickly, right? I say that because being an Elliott wave analyst, what we look for is impulsive trends in a particular direction in the market. And so far, it looks like we have a 5-wave impulse down in the Nifty 50 and the Nifty 500, which sort of indicates that we are not going back to all-time highs, and this rally is going to be a counter trend move, which is essentially a bounce back, a retracement of the entire fall, after which we actually see it roll over and go back to making lower lows below the low that we actually made recently, which means going back below 23,263. Now, if that is the outlook, then it doesn't really make you an aggressive bull. Then you're actually a weak bull. You're looking at just trading in and out of this bounce or this rally and then looking at the downside. But will the interest rate cuts, change that? And so that's the tricky question. If I try to answer that from an Elliott wave point of view, the answer would be a big emphatic no. It's not going to change that. It might end up becoming a sell-on news event, which means that when you actually cut rates, the market believes that, well, you've accepted the slowdown. You believe that the slowdown is here to stay, and which is why you're willing to cut interest rates. And that acceptance can actually be taken negatively. So while the GDP print was not taken negatively and the market has actually rallied after that, the outcome of that, the implication of that, which is lowering rates, can actually end up eventually being negative and end up being a sell-on news. So the print ends up creating the event, an expectation that, yeah, rates are going to get cut, markets rally, and then it's buy an expectation, sell-on news when the actual announcement is made and things turn down. Now, that is sort of how I'm thinking about it. If my wave count is correct, which means it's a 5-wave impulse on the way down, indicating further downside eventually. And if that is the case, then every news event ends up being a discounting of that fact. And that is why this event can end up being a peak. Now, of course, if we have not reached a sufficient retracement of the fall, then yes, it's possible that the rate cut allows the market to continue to push higher and achieve those objectives for a couple of days before really rolling over. So it need not be an immediate timing thing that, event announced and all is done. But it can be. We don't know. We'll have to wait and watch. At least we know that there's a rollover at some point of time coming because of the setup. Okay, and what that also means is that we have to change our ideas about what we think about this market. Can one rate cut really be a reason why the economy starts to improve? So what usually happens is, if you actually signal that now you're going to get rate cuts, things have already slowed down, and prices of everything is up, then what people will end up doing, well, if they're going to do a couple of more rate cuts, why should I buy what I want to? If I want to buy that car, will I buy it right now, or will I postpone that decision and let rates come down so that my EMI can actually be lower, and I'll buy it later, and I don't want to buy it right now. So that's a postponing of the decision, which can end up happening once we go into this phase where growth is already slow and you're trying to cut rates, and which is why one rate cut, as we've seen many times in previous cycles, especially in the US in 2000 and 2008, one rate cut is usually not good enough to turn the situation around. It takes multiple rate cuts before you actually get a turnaround in economic activity. And so will the same thing actually end up happening in India's case as well this time around, where we've already seen a slowdown in earnings growth, we are seeing a slowdown in economic activity, and now when rate cuts start, the first rate cut is really not going to make it, right? It's not going to make that difference, and you're going to need a couple of more before you get the turnaround. And that is why another reason that could be behind the idea that we get a sell-on news kind of setup over here, because things are not going to change that easily if you just start cutting rates right now. But multiple rate cuts are coming. That has been my scenario in the big picture, that eventually interest rates in India are going down a lot. So it's only the near term because of elevated inflation data, and also because the currency has been on the edge, right? The USDNR, which has been very less talked about, has made it very, very difficult for the RBI to actually take that call that they need to cut rates. You can't have an environment in which you're aggressively cutting interest rates and you allow your currency to go into a free fall. So that has been a very, very tough call for the RBI, because simultaneously you also have FIs selling. FIs, when they were actually net buyers in India, were usually supportive of dollar flows into the country. Now that has become a difficult thing for us. We are completely then dependent on trade flows to strike that balance. And if the RBI has been buying back dollars, to hold its entire book together, then it is by itself also weakening the currency. So if it also cuts rates, it will do double of that. And a weak currency has an indirect inflationary impact. So that is something which comes in a hidden way. So far, volatility in our currency markets has been low, which is a good thing. And that is why we've really not worried too much about the weakening in the currency, because the volatility was low. But can we really go ahead with aggressive rate cuts and allow the currency to go into a free fall? That's, I think, another $1 billion question. So that's, I think, something that will continue to hold the RBI back, which is why in one tweet today I actually mentioned that while everybody is hoping for rate cuts, if you actually go and ask analysts or economists, will there be a rate cut? They are mostly saying, no, I don't think the RBI will do it this time. And so it might only end up being some kind of change in language. Like even last time, the change in language was from, easy policy to tight policy and not to neutral policy. Now, neutral is a good place to go after having, moved it to tight. And it shows indication that, okay, you want to eventually go to an easy policy. But how easy is it really going to be? So is the RBI really mentally prepared to take that clue? So they'll have to do it for only one reason and one reason only, and that is to stimulate growth. And to do so, maybe risk some currency devaluation that will happen when you actually cut rates at a time when the USD is already very, very close to all-time highs. So that is, I think, the other catch. And simultaneously, you have the US dollar index also in an uptrend. So that does not really help, because if that is in a downtrend, then or if you have global flows coming into India in a big way, then you can very easily manage these rate cutting cycles because the inflows sort of balance it out. But that's not the pretty environment we are in. So it's going to be a tough call for RBI. I'm not so sure they are going to be able to do what everybody is anticipating, and which is another reason to go back and think why this can end up becoming a sell-on news event when it actually happens. But in the meantime, we are seeing interesting breakouts in particular sectors, especially banking, which is showing decent gains, going past all the highs of the last 1 to 2 months, and probably helps in adding up to further gains for the main index itself, because banking has a large weightage in the Nifty. And similarly, there can be stock-specific news also. We've tried to look at where there are large open interest buildups, and does it really tell us something about the long short positioning there. So if there is a large short positioning somewhere, we can actually end up getting short covering in this entire move. So when we look at the index futures positioning, which is reported by the NSE every day, we do see shorts by FIIs, institutional investors. They have reduced their shorts to some extent, but meaningful shorts continue to be there. So they've gone down from 2 lakh contracts to 1 lakh contracts, but usually in the past, we have seen it reduced to even 35,000 contracts before we can say that significantly the short covering is done. And so that's another reason to believe that, things can still see some more upside in the very, very short term. But all this and more as we actually get to the actual event itself, these are the things we are going to be watching out for. And if the market does run up a lot ahead of the event, I would be slightly cautious. If not, then I think the market might try to, go through with a positive mood. If there's any announcement, even if it's, change in language, it could continue to spur further upside in the next couple of days. But if we go up too fast into the event, then I would be sort of worried about a sell-on news kind of outcome when it comes to the RBI policy meet. So let's see what actually ends up happening. We are also seeing strength in the broad market, which is also another interesting feature of this recent bounce back. where the mid and small cap indices actually fell very, very less during the correction. And now they're actually going up a lot more in terms of the retracement. I mean, the small cap index has already gone past the 61% retracement mark, whereas the Nifty is not even reached the 50% retracement mark. So very, very clear divergent behavior between the large cap and small cap index, as much as we would have thought that any correction in the market which is coming in September and October or after that is going to be driving the mid and small caps down a lot harder. And that's in fact what a lot of people, including me, were saying once the correction started, that you need to be careful about the stocks and try and manage portfolio risk by doing some level of churn, watching which stocks are breaking levels, which are not, and moving in or out of those accordingly. And definitely it would have helped at that level because some stocks have taken a bigger beating than others. But overall, if the index is again coming back strongly, it shows that we are not completely done with the move across the board. And so it's an interesting move up where Nifty is lagging. We're expecting it to stay below the highs, but the small cap and mid cap indices are actually showing a lot more strength right now, meaning that we have to be mentally open that they can actually end up making new highs. So we could end up with some kind of divergence between these indices at the end of the day. And what happens next is something we will only take a call on once the move has played out and once we've actually seen a change in momentum or the behavior of the market. So we're not going to try and preempt it here as to what the outcome is going to be, but stay prepared based on different scenarios that can actually play out. And I've discussed a couple of them here today without too much variation, right? So it's sort of pretty much clearly gives us a picture of what we can expect in the coming days. So that's all I have for you today in this podcast and update, and we'll see you all next time. Thank you.